Fresh details out this morning show the U.S. economy shrank in the first quarter of 2022, but Americans and businesses kept spending despite high inflation and steep prices. Let's bring in Steve Odland to help us break this all down a bit. He's the president and CEO of the Conference Board, a global and independent organization that analyzes and researches economic data. We appreciate you speaking with us about this and helping to digest the new data. So break it down for us. What is behind this what appears to be a first quarter economic slowdown?
Yes, well, it was a slowdown versus a year ago. Real GDP fell in the U.S. Minus 1.4%, and this is following a large 6.9% increase in the fourth quarter of 2022. So it is a slowdown in that sense, year on year. But the decline really reflects a drag in inventories, net exports, and government. Last year we were building inventories at this time following the pandemic, and now there's a less inventory build. And so even though it's a negative number, it is not quite as worrisome as it would seem. Typically a recession is defined as two negative numbers in a row. The difference this time, though, is because of the dynamics behind it, because it went way down in the recession, came way back up, cycling the recession, and now it's trying to normalize. Consumers and businesses continued to spend, and that is the most important thing. Consumers are employed. We have nearly the highest level of employment ever. It's considered full employment, so people are making money. And even though inflation is eroding some of their buying power, you have incredible strength here, and that continues. So you see that investment in housing remained positive. Goods spending was down a little bit because of spending in non-durables. Business investment and equipment, though, rose a really healthy 15%. So it was really net exports and inventories that created this slowdown versus last quarter, but we're not really entirely worried about it.
Okay, so that makes me feel good, because I was thinking, we've been, having all these sort of good news stories. Wages are up. People are picking and choosing the jobs that they want because there are all these jobs out there. And so it was difficult to understand just what the GDP numbers really mean for consumers in the short term, in the long term. Is this something that somebody like me, a regular person, needs to worry about?
Well, it depends on which seat you're sitting in. So from a consumer standpoint, you do have this very high inflation going on right now. A lot of that's driven by the shortages created partially from the continued supply chain issues from COVID, but part of it's from the Ukraine situation. So companies are still trying to normalize inventories and get their stock back up. And as the supply shortages have continued, you see higher prices. That's hurt people because it's eroded their buying power, but they are still employed. They're still getting great raises. So we don't forecast a recession in the U.S. Clearly, this year will be slower than last year. Last year was, then lapping, a recession year from COVID. So it should be closer to 3% growth, high 2%, high twos. This year. And, you see businesses investing, and that's another good thing going on, and consumer confidence remains high. So all of these things say that the economy is healthy, and consumers are really participating in that.
That's encouraging. And Anne-Marie, I love to hear that you think of yourself as a regular schmegular person.
I am,
She's remarkable, ladies and gentlemen.
Regular Philly girl.
But Steve, based on what you're telling us then, it seems as though you're not forecasting a recession. This is generally positive news, but how does the unemployment picture fit in? We know that claims dropped to 180,000 this week, 5,000 fewer than the previous week. What does that tell us about the outlook for the future?
Yeah, a really important question to all of this, because we're kind of running out of labor. Now you're starting to see some people come in from the sidelines. We're still about 2 million people below the number of employed people pre-COVID. A lot of those were people who were dealing with family members, children, and elder care. So you're starting to see that come back. You're starting to see some people who had retired early to come back as well. So the initial jobless claims did tick down, but this is good. I mean, you want people to be employed. You want them not to be relying on assistance, and you want them to have the money from wages in order to spend. And that's really what we're seeing. So the net effect of that is that while real GDP growth should slow versus last year, in other words, it won't grow quite as fast because we're not lapping COVID, it still will be healthy this year. And the participation rate, the labor participation rate, is ticking up, although it's still a little bit below pre-pandemic. So I think net, it's going to be a good year. We're actually running out of labor a little bit. High inflation should continue, but all of that should, by the end of the year, sort of begin to normalize.
Well, Steve, I can stop wringing my hands now. You made me feel a lot better. Things are looking up.
We'll take it. Thank you, Steve.
Steve Odland, thank you so much.
Thank you.